The European Central Bank has announced the results of its much-awaited comprehensive assessment of European banks. It failed 25 lenders and found an aggregate capital shortfall of around 25 billion euro. To discuss this with me today is Martin Wolf, Chief Economic Commentator for the Financial Times. Welcome, Martin. 25 billion is very much at the lower end of what analysts expected. Was this a credible test or a fudge?
Well, as far as I can see, and I'm really not an expert and haven't gone through it line by line, but based on the analysis of people I trust, it doesn't seem to have been a fudge. It seems to have been a reasonably plausible sort of stress test, very similar to what the US Federal Reserve has done with US banks. They've looked at the quality of assets fairly closely. So in and of itself, I think they are indicating that on the standard measures we use, risk-weighted capital, the European banking system as a whole, or at least the core parts of it, are in reasonably good shape, and the capital will be adequate.
Does this mean that European banks will now go on some lending spree which will help the eurozone to recover?
I think that's very unlikely. There's first one question that I want to raise is, are these ratios appropriate anywhere? I mean, the part of that is that they conceal how huge the leverage really is. And there are banking sectors here which are very, very highly leveraged. Fortunately, in the relatively solvent countries like Germany and France. But still, they're very, very highly leveraged. They don't have much capital. And because they don't have much capital, that means they have to actually be very careful about risk, which in a way is what risk weighting is telling you. Is their risk-weighted capital so much higher than their actual capital because they're not taking much risk? Well, that means, of course, they're not going to really drive growth. They're going to do collateralized lending, which is relatively safe. And that really matters for the eurozone far more than the US, because the banking sector is so much more important in the eurozone than the US. So even if they look relatively well capitalized, they may really not be doing much risky lending. And then the second point, of course, which we should perhaps turn to, is demand.
Well, because the eurozone has a problem with its banks, but at the moment it also has a serious problem with demand. And it's not very clear where this demand will come from, because lots of consumers have too much debt, governments have too much debt, and the governments like Germany, which could spend more, just don't want to do it.
Yes, I mean, if you look at the eurozone as a whole economy and you ask yourself how well is the policy system generating demand, it really does look pretty appalling. I mean, nominal demand in the eurozone as a whole is a little over 2%, 2.5% higher than it was before the crisis began. So that's over more than 6 years. So it's sort of an appalling figure. And what it should have been growing is probably over that time, probably about 20%, just to get 3% a year growth, which is compatible with their target, and a very modest growth rate. So then failing to get nominal demand growing, money is not growing because credit is not growing. And as you rightly say, we all know there are collapses in crisis hit countries, but it's not really growing in the core either. And inflation is far too low because inflation, even in the core, is close to 1%. Everybody who's trying to gain competitiveness is being driven into deflation. So the aggregate demand problem is massive, and my view is a sort of chicken and egg. They won't get the banks to lend without solving the demand problem, and they won't get the demand problem solved without the banks lending. And the ECB is really being prevented from solving this problem. And as long as that remains the case, I am really very pessimistic about the future.
So in spite of a pretty credible stress test, there remain lots of problems for the eurozone. Thank you, Martin.
Pleasure.